Hello, ma'am. I am representing Group 3, and our report will be Debt Management of Jollibee Food Corporation. The members are Ambit, Ranyan, Constantino, and me, Ehe. Debt Management Ratios measures the ability of the firm to reimburse long-term debt by assessing the assets of the company provided through debt. Total debt to assets ratio assesses the total liabilities of a company as a percentage of its total assets. In getting total debt to assets ratio, we're going to use the formula dividing total debt to total assets. So total debt in 2015, they have 33,873. In 2016, they have 38,580, 580, 47,666 in 2017, 64,454, 2018, 120,441 in 2019. Their total assets is 65,647 in 2015, 72,879 in 2016, 90,265 in 2017, 114,389 in 2018, and 2019, 171,938. So the Jollibee Food Corporation averages in total debt to assets in 2015 is 0.52, and 2016 to 2016 has an average of 0.53, while in 2018 it has 0.56, and in 2019 has 0.70. So based on the data above, the debt ratio from 2015 to 2017 has been stable with an average of 0.526 debt ratio. In 2018, it increased slightly to 0.56. However, by 2019, it increased to 0.70. It means that for every 1 peso of assets, 70% is financed by debt. This increase is caused by Jollibee's increase in assets and liabilities from 2015 to 2019. In 2019, the 14% increase in total assets to total liabilities was caused by Jollibee Food Corporation's increase of assets from 114,389 in 2018 to 171,938 in 2019, while its total liabilities have also grown from 64,454 to 120,411, respectively. Jollibee's data shows that their debt is lower than their assets. This implies that their assets were utilized well by their operations. In comparison with the industry average, data shows that from 2015 to 2018, Jollibee Food Corporation has a lower debt ratio in comparison with other eating and drinking service business. However, it increased in 2019 and has converged with the industry average and has shown that it has been slightly higher. It is showing an increasing trend but is not too alarming because it is still within the industry average. In conclusion, Jollibee owns more assets than liabilities and, if necessary, could perhaps meet its obligations by selling their assets. Equity multiplier evaluates the portion of the assets of the company funded by the equity of the shareholder. To get equity multiplier, we're going to divide total assets over total equity. So total assets, 65,647 in 2015, 70,879 in 2016, 90,265 in 2017, 114,389 in 2018, 171,938 in 2019, while in total equity, 31,774 in 2015, 34,299 in 2016, 42,599 in 2017, 49,935 in 2018, and 51,497 in 2019. Jollibee's Food Corporation equity multiplier average in 2015 is 2.07, 2016 2.12, and same 2.12 in 2017. 2018 has 2.29, 2019 has 3.32. The data shown above from 2015 to 2016, equity multiplier increased slightly. In 2015, its ratio was 2.07, which means that it's used 48.4% of its equity to finance its assets, while the rest was financed with debt. It has been stable from 2016 to 2017 with a constant equity multiplier ratio of 2.12. It increased slightly to 2.29 in the year 2018, but there is a significant increase in the year 2019 with a ratio of 3.34. It means that the debt portion has increased significantly from 2018 to 2019. In 2019, only 29.85% of assets are financed by equity, while the rest are financed with debt. There is an increasing trend which means that Jollibee Food Corporation has been relying more on debt financing. This does not automatically mean good or bad, as this must still be compared with the industry average. Conclusion: Jollibee uses a large amount of debt to finance their assets. That also implies more financial leverage for the company.
Tie ratio measures the ability of a company to meet its financial obligations on the basis of its current income. To get tie ratio, we're going to use the formula EBIT over interest expense. EBIT stands for equity before interest and taxes. There in 2015, 5,355 is the EBIT. 7,554 in 2018, negative 6,626 in 2019. Their interest expense is 226 in 2015, 386 in 2016, 571 in 2017, 1,207 in 2018, 3,072 in 2019. And their average tie ratio in 2015 is 23.69, 6.26 in 2018, negative 2.16 in 2019. Given in the data above, the time interest earned in the year 2015 is high, in about 23.69, which means that in that year, the company has less of a risk to those long-term investors and creditors in terms of paying off its long-term debts and obligations. It means that for every 1 peso budget for the interest expense, Jollibee Food Corporation has operating income that can cover it 23.69 times. During this time, interest expense was very low and was only at 226. In 2016 and 2017, the company did not indicate their equity before interest and taxes on their income statement, so it is left blank. In the year 2018, however, the tie ratio of the company dropped a lot to 6.26. It meant that the company could still pay its interest expense but with a very low budget, which is 6.26 pesos for every 1 peso of interest expense. Jollibee Food Corporation's operating income actually increased, but their interest expense due to increased borrowing also increased significantly, resulting in the fall of the tie ratio. In 2019, it plummeted to negative 2.16. This was because on that year, Jollibee Food Corporation experienced a negative operating income, which is negative 6,626, while their interest expense increased from 1,207 in 2018 to 3,072 in 2019. Their interest expense probably soared because they need more loans to continue their operations despite the loss. When compared with the industry average of Jollibee Food Corporations was much higher than in 2015. It was still above average in 2016 but was doing badly in 2019 because it was having a loss. So in conclusion, the capacity of the company to cover the interest expense has less safety margin. This implies that JFC continues despite the fact that they need to loan more money for the company to operate.